everyone. Welcome back to the MHP Show Podcast. I'm your host, Derek Vickers. We talk anything and everything mobile home parks on the MHP Show. Excited to be back with you this week with an episode. I have a freaking awesome guest. Before we get started, I wanted to just let everybody know about a couple things. Look, if you go to victorycapital.com, at Victory Capital, we're helping 7 and 8 figure business owners that don't have the time, they don't have the energy, they don't have the mental capacity to buy real estate, deal with the headaches with mobile home park investing, because there is some, right, Jordan? And yes. And, we help you grow your wealth. We help you create generational wealth and passive income for you and your family. So check us out at victorycapital.com, and you can get on our investor list and download the ebook that we have at victorycapital.com. Also, we have our community on Facebook. It's Mobile Home Park Investing Pros. So you can join that on Facebook, Mobile Home Park Investing Pros. If you haven't, I post content and things on there all the time. I do lives specifically for the group. We would love to have you. And anything else, if you want to talk about partnering on a deal, whatever, you can shoot me an email at derek@victorycapital.com or reach out to me on social media. So today, got a very special guest with us, Mr. Jordan Savitsky from 50 West Capital. He's the managing partner there. What's up, Jordan?
How you doing, Derek?
I'm good, man. I commented on your mustache and, I love it, dude. I had one about 9 months ago and my wife was like, okay, you got to get rid of it. So, it made me.
Yeah, my wife, she seems to like it. I don't know. Everyone assumes she hates it, but yeah, she kind of likes it actually. So I'm free and clear. I'm a free man.
Yeah. Yeah. There you go, man. Do you have kids?
I do. I have 2 kids. I have a 4-year-old and a 1-year-old, both daughters.
Oh, nice. Nice. Yeah. We're in the same boat. My daughter's about to be 4 and, my son is about 20 months now, so he'll be 2 in February. Same. So I understand the chaos at your house.
Well, it's totally relaxing, right?
Oh, totally.
It's like a vacation, 24/7.
Especially bedtime. Bedtime is always relaxing.
And I just did a week, first time ever. My wife works at Fox News. And so because of the election, she was literally like in the office from 6 a.m. to midnight every day this week. And so she stayed in New York City. I was solo with the kids. A lot of respect for stay-at-home moms, especially. Man, it's a tough job.
It's a freaking tough job. It is a tough job, dude. And that's what my wife does. And, I'm with the kids for an hour or 2 and it's like, whoa, so I commend you. I know you're a good mobile home park operator now because of what you just told me.
It's a cakewalk compared to kids. So
yeah.
And my kids are good.
Man.
So
yeah, for sure. Well, awesome, man. So, glad to have you on. So tell us a little bit about, how you got into, buying mobile home parks and, kind of what a little bit of your background is leading up to that.
Sure. So I've been an entrepreneur and investor forever. After I went to business school, I worked in private equity for quite a while, about 6-7 years. And eventually kind of moved over to the operations side, the companies that we were purchasing, and would kind of go on to run those businesses until we would sell them. Eventually I left and I started my own emergency medical alert company. It's like I've fallen and I can't get up. You've seen those commercials at night. It's my business. And I was working at a company like that through private equity, and then eventually left, ran that business that we had purchased, and then started my own, and thus began my kind of true entrepreneurial journey. And all along was investing in real estate. pretty much every asset class in real estate, multifamily, student housing, invested in a few student housing developments, single family homes. I did lots of notes. And I've always loved real estate and was sort of biding my time to learn as much as I possibly could and try and figure out, where do I want to go with this? Because I am in the end a real kind of operator. I love getting my hands dirty. And so as I sort of searched for the right time and opportunity to jump in as a sponsor, I just stumbled onto mobile home parks, as I think a lot of people in our industry did. I don't even remember how. I think I was listening to a podcast, like a general real estate podcast, and someone was on talking about mobile home parks. So I started kind of looking into it, learning about it, and I loved it. Almost everything about it. I love unsexy businesses. Every business of mine is not sexy. And there are so many diamonds in the rough when you are willing to kind of go places where others might kind of think are icky, at least where I live in New York. I probably get 5 or 6 pitch decks a week for multifamily deals. Everyone and their brother is doing multifamily, just amongst my neighbors in my community, probably half of the people are in real estate and not a single one is in mobile home parks. I'd never been pitched on a mobile home park. I'd never seen a deck for a mobile home park. And so right there, I was like, okay, well, let me find out why. Either it's a really crappy investment and that's why no one's investing in it, or maybe there's something there and people just aren't really looking at it where I live. And so as I learned more about it, I just kind of fell in love with it and went ahead. First thing I did was I actually hired an attorney, Ferd Neiman, who I'm sure you're familiar with, and probably a lot of other listeners. This is a year before I even had a deal under contract. I put him on retainer just to be able to pick his brain and sort of learn from him. It's the best thing that I have done to date in this industry because I learned a ton. And then eventually, after looking at a lot of deals and traveling half the country, looking at tons of parks, found the first one that that I really liked, made a good deal on it and bought it mid 2023 in Canton, Ohio. That park is just absolutely crushing it. Beating our pro forma expectations by 30-40%, even just in year one. Wow. And so it's really been an amazing experience. And then we bought our second park, which was a much larger park in Virginia just a few months ago. And now I have 2 more under contract, hopefully close before the end of the year. Nice.
Yeah. One interesting thing you said you traveled the country and looked at parks. How many parks did you look at before you found the one, the Canton, Ohio one?
Probably 40 to 50 parks. I have an exact number because I have everything in my CRM. Sure. Yeah, it's probably 40 or 50 parks. I saw a lot of stuff that I didn't like. I saw some stuff that I did like. But it was mostly a learning experience for me. I kind of chalked it up to education. A lot of people talk about, like analysis paralysis. That's not what, I was in. It was really just, if I'm going to, invest my own capital, which I always do. I'm not just raising, money from other people. I'm investing my own money. But I also do raise money from friends and family predominantly. I'm not putting a cent of someone's money into something unless I'm rock solid confident in the industry and also the deal itself. And so I did a lot of due diligence, and just by traveling those parks, I sort of learned what to look for, how to really evaluate things. how to approach due diligence once I had something under contract. And then that led me to my first park in Canton.
Yeah. Yeah. And that's awesome. And the reason why I pointed that out, because I did the same thing when I'm like, hey, I want to get into this industry. I basically, found a list of parks and I drove, all the parks in Central Florida, essentially. Like when the acquisitions team sends me a deal, or, a broker sends me a pocket listing, or a wholesaler, I'm like, oh yeah, I know this deal. I talked to this guy. Like I just know them. Right. But it gave me more like, hey, this is what a nice park looks like. This is what a not nice park. It just gave me more reality on the asset class, right? And I just gained so much more knowledge on the market, on, the parks themselves, like being in them and just getting comfortable around them. So it just made it easier. And in the process, like underwriting deals too, but it made it easier to, like, when a good deal came, it's like, oh, that's it. I want that deal. Boom. I want that deal. So now it's like, if I see deals, I know in like 10 seconds if I want it or not. And it's either like, oh yeah, that's my deal, or no, oh yeah, I want that deal. Like, hey, let's write it up. And I think doing that gives you that kind of certainty. So it doesn't surprise me that you did that and then that happened.
Yeah. And then, something else that I sort of took away from that is I've always been really good about keeping good notes about, every deal that kind of comes across my desk, even before I was really buying parks. So like all these parks that I would go and look at, they were all on the market. I would see a listing, I would talk to the broker just to kind of learn about it, and then I'd go see it. I'd log everything in my CRM, and then I would kind of like wait and see what happened, right? And compare it with my notes. So I'd go to whatever, John's mobile home park that was listed for $2 million. I'd go take a look at it, be there 1:00 on a Tuesday, and like half the tenants are all hanging out, like smoking weed on their, front stoops, and, sort of put down a note. I don't think that's a good sign. It's probably not something that I'm going to want to buy. I wonder if someone's actually going to buy this for $2 million. And then I keep tabs on all this stuff with the brokers. And then, 3 months later, I find out, oh, well, they're lowering the price to 1.5 because, someone put in an offer and it went under contract, but then, they couldn't actually get a loan on it. They couldn't raise the equity money because, the delinquency was through the roof. Okay. Not a huge surprise. And things like that. And so, I sort of like follow these deals through a full acquisition cycle to the best ability that I can. And sort of, I kind of tried to learn, like, all right, well, how much under asking do parks typically end up trading for? If it's put under contract at a certain price, does it end up getting retraded for some reason? And if it does, why? It taught me so much about, all the things that can go wrong in due diligence, all these, just the sort of market conditions in general, where you had a lot of really inexperienced operators who sort of got hot to trot on the asset class because they listened to some podcasts and really had no business putting in offers, buying parks, and kind of set themselves up for failure. And, it's like the cheapest lessons you can learn are learning from other people's mistakes. And there's a lot of those out there in this. And so I kind of sat, on the sidelines, not really, because I was, hauling ass all over the place and underwriting things like crazy for hours a day. But I was still on the sidelines because I really wanted to learn, what am I looking for and what's the best way to sort of, look at a park the second it comes across my desk. Think about, what an offer might be. How do I pro forma this realistically and conservatively? What are all the sort of negatives to look for? And how do I best negotiate the deal to make it something that is likely to close and to do well for myself and my investors?
Yeah. Yeah. I mean, I think that's, what you said, kind of hits it. I mean, you just, being conservative on the numbers, and, I get deal decks sent to me, they're projecting, a 38% IRR or something. And I'm like, okay, sure. We might be able to, in our deals, I'm like, yeah, I think we can hit that, but I'm not going to, promise that in a deal. And, so I think it's important if you know what you're doing, like you're going to know how to be conservative. You're going to know what you can do, like what best case scenario and worst case scenarios are. So
there's nothing that I love more than getting a pitch deck with a 38% IRR, because I just take it right in the fucking garbage. Okay. Because any responsible investor knows that, you don't want to overpromise and underdeliver. And that is like a classic overpromise, underdeliver setup. When you look at most real estate deals that people get, that most LPs get, in multifamily or commercial real estate, the IRRs are usually in the teens. Okay. And so, if you could promise an investor, if you think that you're going to hit a 30% IRR, which is totally doable in this asset class, right? On a value add deal, tell your investors 18%, 20%, even if you think it's going to be 30%, they'll be thrilled. Tell them you're not going to do distributions in year one because you're going to save your cash flow for CapEx. Even though you know that in all likelihood, you probably can distribute, maybe 6 or 7% in year one. They're going to be thrilled when they get a check. So when I get these pitch decks from people that are, I just got one a few days ago. They're saying that they secured a loan with 95% LTV.
Oh,
95% LTV.
Sure.
Like, 40% IRR. And that was just like 1 out of 10, bullet points that were huge red flags. And so you got to be careful when you're a passive investor. And honestly, the most important thing is trusting the sponsor, much more than the deal itself. I can tell you, I still invest, in some deals as an LP, although less and less now that, I have my own kind of deals. But, it's sort of at a point where I have the operators that I trust and I know and have a really good track record with, and they'll send me a pitch deck. Barely even you look at like one page. You look at the projected returns, maybe have a conversation for 10 minutes, and then that's it. I'm either investing or I'm not. I don't need to like stew over it. And so it's very important to be good to your investors, to, take seriously the responsibility of raising other people's money, because, you only got one shot, so to speak, until you have a good track record. Things happen in business all the time. You can never predict everything. Luckily, real estate is a relatively predictable type of business versus what I had been used to previously, where, I have a medical staffing company, a home healthcare company, and I still own those companies and manage them. But, those are, when I was in that world more, you get a pitch deck, it's for like a startup. You have no idea, is this going to work? Is it not going to work? But in real estate, it's not rocket science. And so if you trust the operator, you should be able to do well, except in kind of corner cases.
Right. Yeah, for sure. And I think it's, and it sounds like you're, kind of similar to me. It's like you're putting your own money in deals, you're signing on the debt, you're signing on that, you're guaranteeing the debt. And, if you got friends and family that invest in my deals, people I have to go see on a regular basis anyways. And so I don't think people think about that too, as kind of I've got friends and family in this deal too. It's not like just random people. I don't know. These are people I have to see that are like they want the deal to do good. I want it to go good because that's a family and friend, relationship there. So I think that's huge when you look at that as far as, skin in the game. And, it's important to look at those things, which
absolutely.
Yeah. So I think that's, what you said there. It's huge.
Yeah.
So what is you guys, at 50 West, what is you guys' investment philosophy now, and how has that changed in the last couple of years?
We really look for value add deals. Not crazy, like sometimes you'll see a deal it's like, 150 pads and 5 are occupied. That is not, I'm not interested in that. But, deals where, there might be a few dozen vacant lots, maybe some park-owned homes that we can get converted over to tenant-owned homes, under market rents, obviously. And then one of the biggest things we look for are bad operators that are very short-sighted and just try and fill their parks and then flip them, because even though they come in asking a large price, they never get it. And what we've found, and this is something that we really learned after operating my first park for a couple of years, the people that we had bought that park from, they did a tremendous amount of like handyman specials, right? Where they just kind of took, they didn't have the capital to rehab homes. And they just were trying to, boost the rent roll. And so they would take these, older derelict homes that make the park look like crap. They give them to somebody as a fixer upper, and I mean, this is not like they're giving it to a contractor who knows what they're doing. I mean, this is like you give it to somebody who, barely knows how to like hammer a nail into a wall to hang a picture, and also has no money and terrible credit and almost no income, and like just pretend like, oh yeah, they're going to be able to rehab this. It's going to be a beautiful home. They're going to be a great tenant. Like, forget about it. Right. And so we looked for parks where that's happened, because that's presented us with, I would say, the biggest overlooked cash cow opportunity in this industry, which is getting homes from tenants that fell into that bucket, don't have the money to rehab it, can't really pay their lot rent, and I'll either buy the home back from them for $500 or $1,000, or are we frozen again?
Mm-mm.
No? Okay, good. I'll cut a deal with them, and maybe they're delinquent a month or two after I buy the park, and I'll tell them that I won't file an eviction if they just give me the title of their trailer, and I'll sort of waive their $1,000 that they owe me and just call it a day. And then we get these trailers back. We put $8 to $12,000 into rehabbing it, and then we sell it for $45,000. I'll get them a chattel loan on it from a lender. I'm bringing in, so now I have a home that we're going to rehab, and so it's going to look a lot nicer, which makes the park look nicer. We'll put siding on the outside, we'll put a new roof. I'm going to make like $25,000, $30,000 of profit flipping that home, which goes right to the bottom line to my investors, which they're thrilled about, and as am I. And now I have a tenant who is qualified enough to actually get a loan on that home, right? I mean, this is not like a, $10 an hour burger flipper. This is,
right,
guys who, they work for UPS, driving a truck. They make like $95,000 a year, or like real good working class blue collar Americans, not drug addicts and the lowest of the low. Like, these are like really good people, and so it's like a win-win-win-win. Like, I get possession of a home that I didn't have to pay for when I bought the park. I get to make tens of thousands of dollars flipping it. I get to make my park worth more and look nicer because now the home looks a lot better. And I get a better tenant in who, has a better credit score. They have better income. They're paying their rent on time. And typically, we're setting their lot rent at, a rate that I'm only going to be able to raise existing tenants to, over the course of a number of years. Right. And so we've found that as like the biggest, it's hard to like look for that, just kind of on the face of things when you see a listing. But once you start, asking a few questions to whether it's a broker or, a seller directly, you can kind of pick up on what their strategy was. And you can kind of figure out, were they kind of trying to go the cheaper and short-term thinking route? Because every decision that they make with a short-term perspective in mind, presents a long-term, really tremendous value add opportunity for investors like ourselves that are thinking long-term, and are real buying multiple parks, holding on to them, refining them, taking our cash out, buying more. I mean, this is the game if you really want to be a professional real estate investor. And there aren't really that many of those in our industry. There are plenty, but there are many more people that are not than are. And so that's just a huge, it's great. Yeah.
Yeah. We actually, we learned the hard way on that mistake with some of the handyman specials. Cause we've done that. I mean, in 2021 and 2022, we converted, like 400 homes or something to that. And so we learned the hard way in that, yes, some of the people that we sold to weren't capable of fixing it and whatnot. So we had to go through the process of getting it back and getting someone else. And so now we do, we do extensive, not only just backgrounds and credit checks, but it's also asking those questions like, are you going to be able to fix this and whatnot? We have a whole list of questions where we're vetting people heavily if they're going to come in and do that. Cause we sold homes before where people didn't even fix it. People were sleeping on the floor in like a gutted house. And, and it's just, it's not good. And, we still do that. We still do a lot of the handyman specials, but again, it's heavily sort of heavily regulated by us, if you will, to make sure we get the right person and someone that's going to do what we want them to do with it versus, what you talked about. And we've been able to mitigate that because it's pretty easy to tell if someone's going to be able to do it or not. It's very easy. Very easy to tell. What market are you rehabbing and selling the homes for $40,000? Like, where are you? Like, what market are you doing that in?
Canton, Ohio.
Okay.
Yeah. And also in Virginia now. We just started doing that. We have found that I'm just like looking over here because I have these huge maps of my site maps of my parks on the wall in my office. Looking at all the green and the blue. We're rehabbing this one. We just sold this one. I literally just sold one yesterday, for $44,000, that I spent, I think $7,000 all in, buying and renovating. And so it's really it's like a hidden gem, but I totally agree with you, by the way, on the, handyman special is not necessarily a terrible thing if you know that the person that you're giving it to, is actually capable. Sure. We have, in one of my parks, we have, a tenant who we have hired to do rehabs of homes in the park. He's a contractor. 4 mobile homes is what he does. And he did 3 homes for me and he did a great job. And, so he keeps trying to buy, every time we have one that comes up, he wants to buy it for, a few $1,000 from us. And then, kind of become like a Lonnie dealer. That's the kind of person that I would allow to do that. Happens to be that I have no interest in letting him do it because I'd rather make the money myself. But, certainly if you're, you're quite a few years ahead of me in this. And so you're at a scale already where, I'm sure this stuff is happening almost on a daily basis. I mean, how many parks do you own?
Got about over 40 now. I mean, they're stabilized now, so we don't really have a lot of the crazy shit going on like we did. Like people, we sold homes to people and they would, build like, this is before we had rules against this, because people would build like 5 additions on the side, and you'd be surprised at what people would do to these homes. Like there was a home in one of our parks that I remember we ended up having to demolish it because of some way. The guy, it literally reminded me of like a smuggling house. Like you walked in, walked in the back, and like through the closet, there was this hidden way to get to the other addition, then a hidden way to get to the other addition. And like, you'd be surprised at what people do to these houses. But, if you're going to do that, we found that we could probably, in the markets we're in, I know we could do what you're doing there. I just haven't looked in like, okay, we're going to help these people get like a chattel loan for these things. I haven't looked into that. It always just seemed like, okay, that's a little bit complicated. So we, would maybe do some other options in that case, but we have done that mainly because it's like, hey, if we spend this money, then it may be a little bit harder. We may not be able to recoup it, immediately, but it sounds like you figured out how to do that, which is great. So that's, that's interesting.
Yeah. It's great. You could always do it, like a rent to own, on something like this, especially when you don't really have that much cash into it. You could be talking about like $5,000, $6,000, $7,000. It's not a huge amount of cash that you're laying out, but certainly nothing beats, getting a chattel loan with no PG on the park or myself, and just getting a wire from the bank for 40 grand for that house, and now that's it. Like I don't have to worry about it. I don't have to think about it. I just collect the lot rents and have a much higher quality tenant. Because ultimately, like, listen, the banks know what they're doing, right? And so if they're going to give somebody a loan, they're only going to do it because they're confident that person's going to pay it, especially if it's from a chattel lender that is not taking a PG, like Triad, doesn't take a PG. And so, that's the best underwriting of a tenant I could ever do is put in an application and let's see if you qualify.
Yeah. Yeah, that makes total sense. And what year are these homes that you're doing?
The one I sold yesterday for $40-something thousand was a 1980.
Yeah.
1980. I sold a 1971 home for $36K. One of the benefits I got when I bought my first park was I inherited a really good full-time manager. He's not a typical kind of park manager who's, maybe someone who lives in the community and, gets free lot rent, or they get, a few $100 or $1,000 a month. And then you kind of have a layer of management on top of them and regional, blah, blah, blah. He's like a real, he's a full-time employee. He's a licensed plumber and electrician, which is crazy. And he's great. And he taught me when I first bought the park that you could pretty much rehab any mobile home. Like, doesn't matter if it's from the 60s, 70s, 80s, 90s. Like it has to be really, really bad to be just unsalvageable and be demolished. Sure. That has, we have had that. In this park we just bought, we got maybe like 12 vacant park-owned homes with the deal that we didn't pay for. So, I didn't really care so much about it. as we're going through some of them now, we're kind of learning that, probably at least like 3 or 4 of them are actually unsalvageable. And we'll have to demolish them. But to me, that's like the exception. Unless it's like burned out and, missing half the roof. It could be from 1965 and you can rehab it to look, like it's from the year 2000. You'll never be able to compete with a new home, obviously, because just the way that they build them now is, these new homes are gorgeous. But they also don't cost $30,000-$40,000. And so
that's right.
That was a lesson that I learned. And so we use that to our advantage as much as we possibly can.
Yeah. Yeah, I agree. And I think, we it sounds like we sort of do the same thing with deals. And I learned that in my first.
We should talk,
Yeah, dude, definitely, man. We the first deal that we did, it was 22 units, some vacant lots, and there was 10 vacant park-owned homes that were all just a shit show. And one of them had like a tree growing through on the side. Sold that, someone came in and I sold it for like $500. Someone came in and like this park now is like, just the comparison from what it was before. But that proved to me that like, hey, you can fix any mobile home pretty much, unless like you said, the inside's burnt out or whatever. So if someone has the gusto to go and do it, like you can do it. You can do it. And it's interesting. It's interesting. And I think like, the parks that, we buy, like 0-star parks, 1-star parks, and we turn them into like 2.5, they're not ever going to be the 5-star park in Sarasota down the road here. Like, it's just not going to be like that, but it's affordable housing. So it can be enough. Right. It can be good enough and it can be nice. The roads can be paved. And, I think it's a good strategy if you know what you're doing. What we found is that it's harder to do. Oh, it's not necessarily harder to do in a small market. It's slower. It takes longer to come in and convert the homes and move them in a smaller market versus, a bigger market. Like, people probably heard me talk about this on the podcast before, like our parks in Orlando and Tampa, the homes move quickly. You can vet like good people. There's lots of contractors that can come in and, it's a little bit easier and faster versus even like a little bit north in a market in Ocala, Florida, which is about 500,000 people, which is still a massive market, but it's still slower than Tampa, Orlando, because you have millions in those markets and you have 500,000. So that's why I'm impressed that you're doing that in Canton.
Yeah, well, listen, it's not necessarily the quickest process, right? I'm not going to sit here and tell you that, I put a home on Facebook Marketplace and list it and, within 24 hours, I'm getting like 10 applications with 700 credit scores. But listen, this is a long-term game, right? I didn't raise money and put money into investment to fix and flip. This is a long-term investment. And so, I would rather wait 6 months to find the right tenant to sell that home to and get my selling price, than, just try and sell it to the first buyer that, maybe has some semblance of a down payment and, now I get it off my books. That's just not the way that I approach this. It's not the way that my brain works. And, getting back to what I was saying before about, opportunity that you can find with some, inexperienced sellers, really those two things go hand in hand. It's like they're always trying to take the lowest hanging fruit, like they'll overlook that the application they got in, the person has, a 500 credit score and 3 criminal convictions. They'll go, oh, well, the criminal convictions were for battery. So we don't really know what happened.
Oh, it's okay. He just beats his wife.
I don't know. I'm like, right. I'm like, forget about it. Like, let's just wait. Let's wait. Let's give it another month. Let's see what else.
Yeah.
Because you will find those people. I mean, we started bringing new homes into one of our parks a few months ago, like the beginning of the summer. And the first one we sold pretty quickly. And then the second one, we were just going through, getting a lot of applications, but a lot of them were crappy. And I just kind of kept saying, nope, let's just wait. We'll wait. We're in a good school district. And then 2 weeks ago, I get an application. I thought like maybe it was identity theft or something. Okay. Because this guy had a 785 credit score. Mm-hmm. 785. Okay. That's like a higher credit score than a lot of people that live in multi-million-dollar houses have. And not a single hit as credit, like not a single delinquency. We had like a couple $100,000 of credit that was sort of out there that he was only tapped into less than a quarter of, between some student loans and like a car loan. And so it's like jackpot, these people are out there. And so, I'd always rather wait. I don't have a gun pressed against my head, to, complete the investment cycle, within a certain period of time. I didn't raise a fund. I find that people that raise funds, all is great until they start coming to the end of the fund life cycle and have to, dispose of assets at pretty much any price that they can get because they need to return that money to their investors no matter what, 5-year horizon, 10-year horizon. I don't want to be bound by anything like that. Because in the end, my investors will do better because of it. And so
for sure,
I'm always looking out for my investors first, myself included, obviously. It's why it's so important to have skin in the game. And there's just so much untapped opportunity, even in this industry, when you are willing to have a long-term vision and strategy and be creative and resourceful.
Yeah. I think, if you're listening to this, what Jordan just said there in that last couple of minutes was gold. I mean, it's so easy as an investor when you're using a strategy like that. Like, we have an applicant, they have cash, they're ready to come in and buy, but their credit score is 550. They're late on a couple of things. It is very easy and tempting for you to just be like, screw it, let's just get it filled, right? We need to, fill up the rent roll. But, I've learned from personal mistakes, it's like that person, they don't pay their bills now. They ain't going to pay them. They aren't just going to magically change. Like, I have not found that. And it is so important to be patient on getting people in, because if you don't, and I made this mistake. We had to evict people again. You got to buy their house back from them. It's a pain in the ass. It's not easy. And then you have to go back and sell it again. So really you're actually, what you thought you were doing faster, you could have waited another 2-3 weeks, which really actually would have saved you time, because you have someone that pays on time. They're not a problem. They don't have issues. You don't have to chase down their rent. It's not your operations or your collection team. It's not taking up their time. So it's I think what Jordan just said there is gold, and you need to definitely heed that advice, because that's huge. I just made a huge mistake doing that in the beginning, and it's like, hey, we want to fill these up. We have crazy demand, but you do have to really look at those applications and make a decision on, and have a process to do that. Because if you have a park full of people that are, 450 and 550 credit scores, it's not going to be fun.
No, it's not.
If you get a 450 credit score, like, you got to try. You gotta really try.
I honestly, the first time I saw an application that had it was like a 447 credit score. I didn't even know it was possible. I thought it was like the SATs, like, you get 500 for writing your name or something.
Yeah.
But I mean, why even have a credit score? It should just, like be below 500. They should just go bad. Like, don't lend under any circumstances.
Don't rent. Don't lend.
Yeah. And I mean, also, like you mentioned, like cash buyers and people getting tempted by them. I mean, I got a call from my manager a couple months ago. He said that a guy walked into the office with $20,000 of cash. And my manager is thinking like, he just hit the jack. Like, oh my God, you won't believe it, Jordan. This guy wants to buy this house we have for sale. I know that, this is $10,000 less than we're asking, but I mean, he has the cash. He wants to buy it today. He's ready to sign. And I was like, Ben, take a step back and just like repeat to yourself what you just said. Like, this guy walked in with $20,000 of cash. Where is that cash from? I don't walk around. Do you walk around with $20,000 of cash? I don't walk around with $20,000 of cash. I don't even think you can go to the bank and like withdraw that much at once.
Yeah.
Where did this guy get it? Did he like rob a bank? Did he, so cash ain't always king when it comes to, certainly when it comes to tenants.
For sure.
And so you got to be really careful because, long term, any returns that you get on your investment from selling or renting to those people, going to go right back out the door when you have to turn them over and you got to then rehab that unit again and you got to put it back on the market again. It's like taking money out of one pocket and, putting it in the other. It just doesn't make sense. And too many people do that. But I'm not complaining because every time that happens, it presents an opportunity for me to buy a park where I can inherit, some not great tenants. Obviously you don't want to buy a park that's predominantly like that, but when you have, a handful, there were 5 more homes that they were trying to get occupied before selling and, and they were too lax in their underwriting of the tenants. I'll take it because I'm getting those homes for free and those will become cash cows for me.
Yeah, totally. Yeah, look, I think the way I like the way you think about deals. I mean, we think, very similarly in all aspects, I think, from the acquisition perspective and to the operations perspective. And I mean, it sounds like that you've learned that, in the beginning, maybe you saw, I don't know where you learned that, but like, unfortunately I had to learn that the hard way. And it's good that you're already, learning some of these things and implementing these things that like, hey, it's just tempting to get tempted to do some of that stuff in the beginning, but that's awesome, dude. I love it. What do you think when we're closing out here? Like, what do you see the future of the asset class? Like, do you see anything that could come in and kind of disrupt it?
Not necessarily. I mean, obviously, every year there are probably hundreds of parks that are getting redeveloped, and, a handful that are getting developed. And even the ones that are being developed, I mean, they're basically like single family home subdivisions, with double wides or modular homes. Like, I mean, they're not building new trailer parks. Like,
right.
And so, it's a diminishing asset class in that there are less and less of them. But it's just going to make the ones that exist more valuable. I think that, institutional level, buyers will start to, look at smaller parks, maybe as part of portfolios. Right now they're not going to touch something that's less than, 400 or 500 pads at least. And, is like a Class A kind of a park. I think that you're going to start to see, institutional interest in, in, not tiny parks, but, in smaller than what they're looking at now. The fundamentals of the asset class will remain strong. There will always be people that need affordable housing. There are more people every year, every year, the population grows. Older people that live in these parks, that have lived in these parks forever. People are living literally decades longer now than they were even 20, 30 years ago. And I know this firsthand from my healthcare businesses. In the 1980s, the average age in a nursing home was like 65. Imagine that for a second. 65 years old. Okay. And now it's like in the high 80s. And so you have all these residents that live in these parks that, 20 years ago, they 65, like they're dead, or they're moving to a nursing home. And now you got to, fill that lot again with someone new. Now they're staying. They're going to stay for another 5, 10, 15, 20 years longer than you maybe anticipated. I only see tailwinds in the industry. I think that as buyers, we're going to continue to, I know it's been sort of choppy, especially this year in terms of deal flow, the last 2 years. A lot of sellers kind of have in their heads that, rates are going to come down and then they'll be able to sell for higher prices again. But I think that they're now seeing that that's not really true. Rates are not going back to like 2%. They're when they drop rates by 25 basis points, like that's not going to have a significant impact on your ability to now sell your park at a 5 cap.
But some of them think also, it does.
They do, but I think they're starting to see that that's not true. And especially now where you're seeing that, just yesterday, the Fed dropped interest rates again by 1/4 point. But the 5-year treasury is up. Okay. Because the 5-year treasury, which is what most loans are based off of, is not actually correlated with Fed interest rates. People don't seem to understand that. It's much more correlated with the market and the economy and people's thoughts on the economy than it is about what the Fed sets rates at. And so, I think that you're going to start to see a lot more volume, on the buy side. And that's going to give a lot of opportunity for people like us that are looking to acquire parks. And I'm really excited for what lies ahead. And, I'm looking to build to, 20, 40, 80, 100 parks, as big as I can get.
Yeah. Yeah. Well, that's awesome. And I agree with you on the future outlook. I think there's going to be, you've already seen transaction volume pick up a bit from 2023. It's picked up. And now that the election's over and things, I think it'll start to pick up more, because even in 2020, when the election was happening, there was a lot of uncertainty before, and then deal flow started to pick up a little bit after it. So, my hope is now that we have some certainty around that, deal flow will pick back up. But so where can people find you if they want to reach out to you, Jordan?
Yeah, sure. They can find me on LinkedIn, or, you can send me a note, Jordan@50westcapital.com. I'm sure that you talk about this on your show all the time, because we're in the same business, but, to the extent that there's no such thing as mailbox money, there actually is a thing, mailbox money, and it's called being an LP investor in a real estate deal. And it's a great thing to do. And so, I'm happy to talk to anyone and everyone, as I know Derek is also, and, looking forward to, many future years of success in this asset class for myself, my investors, and colleagues like you.
Yeah. Awesome. Well, thanks, Jordan, and appreciate you being on. So thank you everybody for tuning in to the MHP show this week. You can reach out to me, at Derek@victorycapital.com. You can reach out to me on the social media platforms. We'd love to help you in your mobile home park journey, however I can do that. And please like and subscribe to the show. Subscribe to the YouTube channel. We're going to start dropping more short form content on YouTube. So check that out. And we will see you all next week on the MHP Show. Peace out.